Welcome back to the Automotive Market Minute, which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Tripotowski.
And I'm James Sivko.
I am so pleased to tell you that we had a bit of a rock star June. We're going to be covering the Fountain Ford dealer performance, car buying intentions. What's holding up gas prices? Lots of news there. The consumer cash balances on the rise, something you're probably not hearing about. Fed funds expectations. We got a new head honcho over at the Fed. What the hell is he going to do? And then, of course, my closing monologue looking forward. I'm switching from bearish to bullish for just a little bit of time. Don't know what's going to happen in the future, but I'm feeling pretty bullish going forward.
If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support.
So 128 dealers, we've officially reached 30 states. It feels good to be in the majority of America. It feels really good. Interesting numbers here. Traffic is down, leads up a little bit, appointments down just a hair, new sales bump, used sales bump. But here's the interesting thing. Appointments year over year up essentially 13%, new sales up 11.2%. I'm calling it right now. Is AI, which has been widely adopted across the automotive space, is that what's increasing these appointments? It feels that way. The data looks that way year over year. We have dealers in which, in many scenarios, have less demand than they did a year ago, but they're getting more quality appointments and they're doing more with them inside their store. One thing from a conversation that I had with a dealer last week, they're feeling the pressure when the consumer's coming in the door, but they feel like the financial institutions are trying to support them. And I'll be touching on that at the end as we look forward in my closing monologue, but they feel like they're getting help. Now, are we extending the loans? Yes. Is average negative equity higher? Yes. But if you want to sell cars, a financial institution that's willing to help, a factory that's willing to give better incentives, and a consumer that's willing to stretch a little bit longer for their lifestyle, seems like sales to me.
Retail sales in general have been pretty strong. And this chart actually lags the activity that we've seen pick up over the last 2 months. So our line that's slightly below this long-term trend line is hooking up toward the trend. So when we do see, and we think we will see, stronger consumer behavior over the next 2 or 3 months, that's really just consumers catching up. It's not consumers pressing or outspending. They've just delayed some purchases over the last several years post-COVID, and they're playing catch up. We think that you're going to see some of that in the car business over the balance of this summer into the early fall. We are seeing this pattern of consumers complaining while buying. And these, of course, consumer surveys, especially the University of Michigan Car Buying Intention Survey, really leads car sales. And so in this graph, our unit sales are the dark blue line. We just had a great month, which is going to shoot up here at the end of this graph. The orange line is the car buying survey from the University of Michigan. And this little gray line here is a subset that Michigan is trying to deal with. And that is a bunch of people who are crazy and who are answering the survey based on political beliefs or trying to score points by pressing a button and aren't really interested in answering a survey about buying cars. We expect the Michigan guys to be able to snip this out and to get us a better survey. We're seeing things like 50-year lows in sentiment, and it's really just a bunch of people messing with the survey. Gas prices. Why are they not going down as quickly as we would like when you see a chart of crude oil dropping as hard as they can? And that is, there's only so much crude oil you can jam through a refinery to make motor fuel and other products. And you can see the refiners are trying to run these refineries as hot as they can and cut down on downtime and increase utilization and do extra shifts. So one, it may take a couple of months, but relief is coming. It's not really the gas station. It's kind of the refinery that's in the middle of this process where the bottleneck is. That's why prices aren't coming down as quickly as possible. Help's on the way.
Strait of Hormuz gets shut down. Now there's less oil coming. They can't refine because they don't have enough. Therefore, refineries slow for a little bit. Now, even though a lot more oil is coming in, you're saying, if I'm hearing correctly, that they're smashing into the ceiling when it comes to refining that oil to be able to get it to the actual consumer. And that's why we're still in this situation, which, by the way, if we were to go back and clip it, I'd call it 3 months ago or so.
The trend is probably, unfortunately, still up because the oil market It's a heck of a symphony.
The gas prices are not coming down because you predicted this was going to happen.
This line, the seafoam colored line that is 2026, can only go so high above prior years. The great thing about living in the US is that we can get our millions of barrels of oil per day when we need it. Most of the problems are in other parts of the globe where they can't. So all the activity takes place at a higher price. Our guys are trying to pump as much motor fuel as that we possibly can to drive the price down. It's just going to take them a while.
What are we seeing with the consumers?
This is a really interesting trend, and it is about a 5 or 6 year trend. And when inflation took off, consumers all collectively decided, whoa, I need more money in my checking account. So these are families that would have $3,000 in the checking account at the end of the month, and the next paycheck comes in and they work on their monthly project again of financing their lifestyle. Now they have an understanding that they need $4,500 of cushion in the checking account. And that's just consumers preparing for the big ticket things that always seem to show up, whether it's car insurance every 6 months or school tuitions or trips or vacations. Consumers need more cash in their checking accounts. And we can actually measure that against a trend in the next graph. If we look at this, you can see this bubble here post-COVID, just boom. The cash balances rose because of transfers and because of handouts from the government, but now they're going up because compensation and salaries are going up and because cash requirements are going up in the households. Consumers feel like they need more cash, and I think they're right. The fun part about this is the payoff for dealers is there is more cash lying around that can be jammed into a deal, and consumers can temporarily just have a low cash balance when they drive off the lot. So this is supportive of transactions. And if we take a look at the next graph here, it is most supportive, of course, in the first half of the year as tax returns come in. And then most consumers, it runs down through the rest of the year. Only at the very high end do consumers midway through the year hit their Social Security maximum and they get a little bit of a bigger paycheck. So almost all consumers, you're going to see this trend. And you can see our seafoam line here in 2026 is a little bit above the rest. We're having a very good year in terms of customer liquidity. There's cash to be jammed into deals. Another way to look at this is there's consumers have more cash, but kind of businesses and everyone is deciding to carry more cash, and the government has been and continues to print money. This is a line that always goes up. This is percentage change of cash and near cash, the so-called M2 money supply, cash, bank deposits, money market funds, that kind of stuff. And you can see the long-term trend line is it kind of goes up around 5% per year. That's why we have some inflation measures that go up about 5% per year. And this is just data that we have going back over 60 years that the money supply tends to grow. Consumers will adjust accordingly, and we're just going to all operate with a little bit more cash than we typically had. The next graph, where all the individual governors are and where they think inflation will be in growth and all this stuff. Well, if we simplify all those dots into just one big dot, you can see that the story as recently as March was for rate cuts, and a couple of them, and a couple of supportive rate cuts to come over the next 12 months. The Fed governors themselves are even starting to toy with the idea and float the trial balloons of maybe some kind of a rate hike. And if we look at the next graph, the market is starting to listen. So we now have a market here that has a Fed funds rate that could go up by about 50 basis points between now and the springtime. That would imply two of those smaller cuts. Typically, when you really do have a new chairman of the Federal Reserve, he likes to be the new sheriff in town, snug money supply a little bit, make it a little bit tighter. And so we may see a rate hike. They have other tools other than just rates. So there may be a snugging of financial conditions here because the consumer is running so hot and because the economy is running pretty hot now too. So just eyes open, it might happen. The seafoam line here is Bank of America kind of stepping out and saying, look, we may even have a late summer. Bank of America is very, very bullish on the consumer, and that's why they may be expecting higher rates.
Number one, what's the economy going to look like if we get a 50 bip bump? Number two, when you say other tools in the belt, give us some examples.
An example would be the Federal Reserve has expanded its balance sheet. So the Fed has just bought stuff. They've bought mortgages, they've bought treasury bills, they've bought treasury bonds. And whenever you do that, that just layers cash into every financial institution, and that cash has to find some kind of a home. Hopefully, it's to make more loans. Well, that big fat balance sheet, the Fed can just reverse it and shrink it. And that would be a way to snug conditions without necessarily giving people interest rates that are inconvenient for them. Our economy would change a little bit. I think it would slow down sectors that are very, very sensitive to rates, mostly the housing sector. I think would take the brunt of the impact. Certainly, we're out in the 3 to 5 year part of the curve, so our auto loan deals would be a little bit more expensive next year.
I've been looking at the whole housing situation in the US right now and the fact that there's still a shortage, yet listings are sitting longer, but it's because rates are so expensive. But historically speaking, they're not that expensive, but the homes are really expensive.
When it comes to being an auto dealer, the more consumers put off a housing decision to take on more debt and buy a house, the more of a chance that they just try to get a nice set of wheels and put them in the garage. So you're not necessarily rooting for the housing market when you're sitting in the sales tower.
To wrap things up for this July update, let's look at the incredible momentum we saw across the industry last month. The national market surged to a massive 16.5 million seasonal adjusted annual rate, completely outperforming early analyst forecasts and even beating our own internal projections, which, by the way, were closer than the big players. The energy out there is undeniable, and it proves that the consumer velocity in this market is alive and well. As a general manager looking to maximize your summer, the strategy isn't just about riding the headline wave. It's about understanding the exact engine driving it so you can capture your unfair share of market. While the big macro numbers got a strong seasonal boost from rental and commercial fleet deliveries stocking up for the summer travel peak, the true retail consumer side is playing a highly calculated game right now. Look at slide 7 of the presentation. The consumer is telling us that the sticker shock is top of mind. The average transaction price is hovering over $46,000, and with interest rates holding firm, as we just talked about, the average monthly payment has climbed to a historic $813 a month. Buyers are hungry for vehicles, especially those who are waiting to sell their house, but they are pulling highly specific financial levers to get them. The latest data from Edmunds revealed that a record 36.5% of new vehicle buyers are now stretching their loans past 72 months just to make the monthly math work. In fact, nearly 1 in 4 are pushing clear out to 84 months. But look closer, because you can't look at that 7-year loan stat and think people are financing compact cars until 2033. That is not the case. This is heavily driven by the truck box. On full-size trucks and large SUVs, an 84-month term has basically become the new industry baseline. When an enthusiastic truck buyer fields a $65,000 sticker price with less than $6,000 down, a 7-year loan is the only mechanism left a desk manager has to keep that payment manageable. They want the vehicle, they have the appetite. They're just adjusting the terms to fit their lifestyle. Some would say it's the American way. And this is exactly why our Fountain Ford client data is so incredibly encouraging. Our stores ground out a 3.1% month-over-month increase in new sales and a 2.2% bump in used. Squeezing higher sales out of a month where raw appointment data actually went down shows us looser financial conditions, and a motivated sales staff can move mountains. Well, how did you do that? While traffic was down, your leads were actually up. High intent retail buyers are sitting on your website, structuring their payments, and doing the heavy lifting digitally before they ever step on your concrete. Many teams desk these deals cleanly and captured real market share. The topic I had the entire month was, how is your merchandising and how does it compare to the guys you're trying to beat down the road? If it doesn't compare, why should your consumer care about you? Manufacturers are helping keep the assembly lines moving with incentives holding right around 6.2% of MSRP, but they aren't flooding the market like they did back in 2019, which hovered around 10%. They're giving you a steady tool, not a total bailout, which is why managing those trade-ins, where nearly 1/3 of buyers are bringing an average of $7,200 in negative equity, requires absolute process precision. But here's the exciting part, and the real reason to be incredibly bullish, yes, I said it, about the rest of the summer. The wealth is there. Bank of America's latest internal data shows that all income cohorts saw a lift in deposit balances this year, and households are holding over $3 trillion in cash above long-term trends. The consumer has the liquidity. They're just waiting for a professional, transparent dealer who can help them solve the monthly math, bridge that negative equity, and navigate these extended finance cycles intelligently. Your teams have a golden opportunity to dominate the rest of the summer. By leaning into payment-first digital retailing, aggressively targeting your database for equity resets, and keeping your process fast and transparent, you can unlock that consumer wealth. It's waiting for you. The momentum is real. Your execution is proven thus far, and you are perfectly positioned to win the rest of the summer. On behalf of my esteemed colleagues, Mr. James Sivko and Mr. Phil Chebotowski, my name is Steven Georgella. What a wonderful month of June, and God willing, we'll have a great month of July. We'll see you next month. Out.